Assalamu alaikum wa rahmatullahi wa barakatuhu. Welcome to my first presentation at AAOIFI. I want to discuss with you an overview of Takaful in light of the AAOIFI Shari'ah Standards. Now, my name is Faizal Manjoo. I'm from UK. I'm the CEO of Minarah Consulting and I'm a consultant in Takaful. My background is I'm a lawyer by profession, but also I studied Sharia, and my PhD is an extension of Takaful, in other words, on pension. And I'm a lecturer in few universities and sit on various Sharia boards. That's very brief about me. And today we're going to give you a bird's eye view of the various sections which will happen to help you in the Takaful concepts. So briefly, the first slide, I'm dealing just to tell you the menu for today's talk is definitional issues between insurance contract and Takaful. Number two, we're going to deal with the contractual engineering for Takaful models. And finally, distribution of underwriting surplus. These are the three main areas I'm going to cover. And the other issues, I will allude to that during my delivery of the lecture. So the first one is definitional issues between insurance contract and Takaful. The reason I want to highlight this area is because if you don't understand the problem, what is a policy, insurance policy, you won't understand the rationale for developing the Takaful industry. So what is a policy? What is an insurance contract? As the word is telling, it's a contract. So you have to understand there's a whole entire debate of contract law. And the contract of insurance in law, we say it's a sui generis nature. It is a contract, but there are extra things involved in it. It's the normal thing that you'll have in a contract, such as offer and acceptance, etc. So in a nutshell, the legal definition of a contract of insurance is that it is a contract whereby for some consideration, in other words, a counter value in a contract, generally, but not necessarily for periodic payments called the premium. So you give your premium, you must pay a premium in exchange of having a benefit, indemnity in other words. So the insured secures some benefit on the occurrence of an event. So you register, you pay a sum of money called a premium in exchange of transferring your risk to the insurance company. Now the question here is, what's wrong with that? Now you are giving money for money. And that then amounts to riba, because if you are getting more money from the insurance, that excess is money for money. And this is where the ulama say you got an element of riba in a contract of insurance. Then we continue. The event must be uncertainty to whether it will happen or not. Or if the event will happen, there must be uncertainty as to when. Now, this second part, you will not. If you know exactly it's going to happen, then you don't need to industry because everybody will exploit the situation. This is where uncertainty, the event must be uncertain. The insured event must be uncertain. Now, this brings in a second problem from a Sharia point of view. If there is uncertainty about the event, let us take the case of a car accident. For you to get a car insurance policy, you must not know when the accident will take place. So that brings an element of gharar. Now, we don't know when it's going to happen. You don't know how many years you got to pay for that. And if you have an accident, what is the quantum of damages? So all those things are what we call a fahish, excessive uncertainty. And Sharia does not endorse that. Rasulullah said, Nahar Rasulullah an bayil gharar. Rasulullah forbids such type of transactions. So this is a second element which renders a contract of insurance haram. The third part is the event must be adverse to the insured. That is, you must bear a loss, what you call an insurable interest. You must have an insurable interest in the matter being insured. For example, you have a car. So if you lose a car, it's an insurable interest. Or say, for example, you take a life insurance policy on your employees, for example. If something happened to your employees, you're going to bear the loss. So this is what basically the insurable interest is about. Now, the adverse to the insured means when you're buying an insurance policy, you are under the idea of that you will have an accident, your risk will materialize, Whereas the insurance company, law of large numbers and mathematical formulas and actuarial science, they will tell you, no, I will insure you because this will not happen, because according to the law of large numbers, you are falling within specific range. Therefore, I can't take your risk. That brings another problem, the element of gharar into the contract of insurance. So you see that if you look at the contract of insurance, the policy, you have three main haram elements. One is riba, which is from the Quran. The second one is gharar, which is from hadith. The third one is maisir, which is from the Quran. So for this reason, the ulama say that the contract of insurance is haram, but not the philosophy of insurance. Now, from what we have discussed, the very basic nature of a contract of insurance is what you are doing when you pay premium. You are transferring your risk. This is very, very important. You are transferring your risk to the insurance company in exchange of the premium you are paying. And when you pay that premium, it entitles you to be indemnified upon materialization of the risk insured. The second one is the contract of insurance. You are selling something which you do not know whether it exists or not. And that is the nature of insurance contract. The third point is a contract of indemnity to be shouldered by the shareholders, because you have transferred the risk to the insurance company, which means they bear the responsibility of indemnifying you or compensating you upon materialization of the risk insured. So it is a risk contingency contract. However, you will realize that without an insurance policy, insurance industry in a modern economy, it would be virtually impossible to run it. It is a necessity, and by law, many risks are to be insured. So a contract of insurance is the backbone of the industry. It has its own specific characteristic. Now, how do we resolve this problem of the three riba, gharar, maisir? This is why the AAOIFI Standard 26, Section 2, the AAOIFI has given a well-encompassed definition. I have highlighted the main concepts in bold character, as you can see. Islamic insurance is a process of agreement. That is very, very important. We're talking of an agreement, not a contract per se. In other words, it will be a unilateral. It's an agreement. Not all agreement are contracts, but all contracts are agreement. It's quite a bit okay. So it is an agreement among a group of persons to handle the injuries resulting from a specific risk. That is very important. It is very specific risks which are being insured. And the very, very important point here is what I put in bold character there, to which all of them are vulnerable. In other words, the people will be vulnerable in the sense that they are all exposed to the same risk, but in other words, they're going to share that risk. They are not going to transfer the risk. This is fundamental to understand between transferring a risk in exchange of a premium and sharing a risk. So the AAOIFI is highlighting this point that all are sharing that risk, but we are vulnerable to it. That's the first section. The second part, the AAOIFI definition, is that a process thus initiated involves payment of contributions as donations. Now, a donation is unilateral, whereas a premium is bilateral. Again, from a fiqh point of view, this is very important to understand that gharar, riba, maisir will occur in a bilateral contract and not in a unilateral contract. Because when you are going to enter in a contract whereby there will be gharar, riba, maisir, there is an element of exploitation. One party will exploit the other. The whole debate about the zero-sum game. Now, with Takaful, it is a donation. So you create a pool of money and you're donating in that pool, and with the idea that each one will jointly guarantee the other. So the responsibility is not a transfer of share of risk, but it is a sharing of risk. This is fundamental. So we have already two differences here. One is transfer and risk. Number two, you don't pay premium In other words, you enter a unilateral contract, thus you're eliminating the riba gharar maisir. And that leads to the establishment of an insurance fund that enjoys the legal status. The pool you're creating, according to AAOIFI standard, this is a legal entity, just like a limited liability company is a it's a legal entity, is a legal persona, as we call it in law. In the same way, that pool of Takaful becomes a legal entity. Hence, it has independent financial liability. This is why in the accounting standard of AAOIFI, you will find there are 12 financial statements which you have to develop, because the way you treat them according to accountancy will be different as compared to a conventional insurance. This is another topic on its own, the accounting for Takaful company. The third point, the resources of this fund are used to indemnify any participant who encounters injury. And this is very important. The philosophy of insurance is the same one we use in Takaful. That is, the many lucky ones helping the few unlucky ones, applying the law of large numbers. So if you got 1,000 participants, maybe 10 will suffer the risk. So 1,000 are putting money together to shoulder maybe 10, 15 people, right? So we're going to be indemnified, you're going to be compensated upon materialization of the risk insured from the fund you have created by the donations. And this is subject to a specific set of rules and a given process of documentation. The fund is managed by either a selected group of policyholders or a joint stock company that manages the insurance operation. And this is very important to understand the legal relationships between the policyholders, who are technically the participants donating the money in the pool, and the person or the entity that will manage that pool. Because usually policyholders or participants are not experts in actuarial science or in insurance. So therefore, the joint stock company that will manage it, that is, you create a joint stock. I'll come into that in a few minutes. And they also not only manage the pool, they will invest it against a specific fee. Now, this is according to the standard 26.2. You can read that at your leisure. You got to halalize the insurance concept. So what I mean by this is the philosophy of insurance is you put many lucky ones helping few unlucky ones. And that is 100% in line with Sharia. وَتَعَاوَنُوا عَلَى الْبِرِّ وَالتَّقْوَى. This is what the Quran says. You help each other in doing good action and fear of Allah. So we are all putting our efforts, our resources together to eliminate riba, gharar, maisir. That is a rationale of takaful. And the word takaful itself derived from the word kafala, which is to guarantee. So you are joint guaranteeing each other. So the model is fundamentally different from a conventional insurance, whereby you transfer your risk, where here we are sharing the risk in a unilateral fashion. Thus, it is a unilateral contract. So to halalize an insurance concept, what we are doing, we are shifting from a bilateral contract towards a unilateral contract. Thus, we are eliminating, we are mitigating the concept of riba, gharar, maisir. And this is approved by the majority of ulama in the world, the Majmu' al-Fiqh of Jeddah, the ulama of Makkah, in Malaysia, and this is why it has been accepted. So there's no transfer of risk, but rather sharing of risk, which is more in the spirit of Sharia, thus eliminating the haram elements. Now, what to appreciate here is, in practice, you need to get a license, and that will impact on the model that you want to create. To get the license, according to the Insurance Act, you need to have a limited liability company. And the promoters who are going to create that, and you are, depending which country you are, usually you have an Insurance Act that will tell you how to get a license, who are to be the directors, etc. So such company runs an issuance of shares, which is technically bought by the promoters. So when you create a limited liability company, that will be under the Insurance Act, the Insurance Act and the Companies Act. Therefore, you will have to have a authorized capital, and that authorized capital will be raised by the promoters and they are the one who will manage the Takaful pool. So you got two sets of accounts. One is for the shareholders who creates that company to get the license. So this is covered under Standard 26.3, Section 10 provides details of the Takaful operator's scope of operation, which you can read. So the share capital is kept separately because this is owned by the shareholders who are technically the promoters of that company from the donations contributed by the policyholders. So you got the risk pool, which is the Takaful pool created by the donation. So once they got the license, this will raise the money through the issuance of shares. This is your capital. Once you got the license, you become a limited liability company. Therefore, you can give the service of managing the pool of the risk pool of the Takaful. Now that becomes another fund where the donations goes into. This is under the AAOIFI Standard 2632. And very interestingly, even non-Muslims can be participants because there's nothing in Sharia where a non-Muslim cannot guarantee a Muslim. So that is the great idea of Sharia, where we engage with a wider population. So the donation to be paid is actuarially determined. Again, this is covered by the Standard 26722. This is very, very important because to do insurance, you need data and you got to be very, very precise using mathematical modeling, whether to take a risk to calculate the tabarruat, etc. This is a very specialized area in insurance. The third point is there are two sets of capital now. Very clear. One is for the shareholders account, which creates the share capital, and the other one is the Takaful risk pool. So you can read section 3.1. The Takaful risk pool is treated as a separate entity, as I mentioned. Thus, it is the Takaful pool that will be, when you create it, will have a set of relationships, contractual relationships that we're going. Now, what to appreciate here is, in practice, you need to get a license, and that will impact on the model that you want to create. To get the license, according to the Insurance Act, you need to have a limited liability company. And the promoters who are good, and you are, depending which country you are, usually you have an Insurance Act that will tell you how to get a license, who are to be the directors, etc. So such company runs an issuance of shares, which is technically bought by the promoters. So when you create a limited liability company, that will be under the Insurance Act, the Insurance Act and the Companies Act. Therefore, you will have to have a authorized capital, and that authorized capital will be raised by the promoters, and they are the one who will manage the Takaful pool. So you got two sets of accounts. One is for the shareholders who creates that company to get the license. So this is covered under Standard 26.3, Section 10 provides details of the Takaful operator's scope of operation, which you can read. So the share capital is kept owned by the shareholders who are technically the promoters of that company from the donations contributed by the policyholders. So you got the risk pool, which is the Takaful pool created by the donation. So once they got the license, this will raise the money through the issuance of shares. This is your authorized capital. Once you got the license, you become a limited liability company. Therefore, you can give the service of managing the pool of the risk pool of the Takaful. Now that becomes another fund where the donations goes into. This is under the AAOIFI Standard 2632. And very interestingly, even non-Muslims can be participants because there's nothing in Sharia where a non-Muslim cannot guarantee a Muslim. So that is the great idea of Sharia, where we engage with a wider population. So the donation to be paid is actuarially determined. Again, this is covered by the Standard 26.7. Important because to do insurance, you need data and you got to be very, very precise using mathematical modeling, whether to take a risk to calculate the tabarruat, etc. This is a very specialized area in insurance. The third point is there are two sets of capital now. Very clear. One is for the shareholders account, which creates the share capital, and the other one is the Takaful risk pool. So you can read section 3.1. The Takaful risk pool is treated as a separate entity, as I mentioned. Thus, it is the Takaful pool that will be, when you create it, will have a set of relationships, contractual relationships that we're going to deal with. So when you're creating the Takaful pool, you got to understand the concepts involved. One is what I would call the compulsory elements. That is, you got to have the idea of joint guarantee, and that will apply to any type of model you use. This is where you get the Takaful. The point two is tabarru. Once you decide to joint guarantee each other, you got to put the resources, in other words, your money into it. So that is known as tabarru, which is unilateral. So any form of model you create, you must joint guarantee and the concept of donation, which is unilateral. From there now, how do you organize your pool? There are various models. One is mudaraba. In other words, the company that created the shareholders account, they will appoint a takaful operator, and they will operate as a mudarib. In other words, you as a policy holder or participants in the pool, you give the capital for the pool, and they will give their know-how. This is a contract of mudaraba, which again, there is an entire section or standard on that in the AAOIFI standard, Shari'ah standard. This is the first model. The second one is wakala. So with mudaraba, you got a predetermined ratio of the profit, which you generate from the investment of that money, donation. The second one is wakala. In other words, you take an agency profit, you take an agency fee upfront. Another model which is expanding in Pakistan, in South Africa, is a waqf model. So whatever profit is generated, it is plowed back into the waqf. Now what would happen, each model here got its own advantages and disadvantages. So what we see in the industry, there is hybrid models where you can have a mudaraba with waqf or wakala with waqf, or you can have mudaraba and wakala. There are various models on the market. I got about 20 models of takaful, which can be put into execution, like the model of wadi'a. There is also musharaka, etc. I'm not going to discuss this here. So the point I want to raise here is when you set up, you want to structure your takaful company, there are a set of concepts which you must have in all the model, joint guarantee and the donation, and then you got various type of concepts where you're going to. Now, this is very important. How do you structure the pool and the relationship? According to the AAOIFI standard 26, section 4, they highlight three relationships. The first one is the participants in the pool. They're having a musharaka participants. That is, they are putting money together for a given endeavor. What is this endeavor? If there is any risk being materialized, they will take the money from the pool and among themselves, they will help each other. And that pool is a musharaka. This is standard 26/4/1. The second one is there is a relationship of wakala and mudaraba between the participants and the company. As I told you, the company is created under the Insurance Act and the Companies Act so that you can get your license. But they are not going to take the risk pool for them. They got their own authorized capital as an entity, but they will appoint a takaful operator. And the takaful operator is representing the company, and they will create a relationship of agency and a partner in giving the labor, that is wakala and mudaraba. This is under section 442. The third relationship is the participants and the funds for donation and indemnification. So that also is very important. As you can see, the fund is a legal entity in the middle, and you get the three circles which is linked with the fund. And this is very important to understand. The fund is a legal entity in a takaful setup. So you understand the contractual relationship. How do you create the pool, the various modalities available, and what type of contractual relationships? Okay, these are a very basic one. Of course, as the industry develop, there will be other types of contractual relationships that will emerge. Now we come to the third part, which is very contentious, and which is addressed by the AAOIFI standard, is a distribution of the underwriting surplus. In a conventional insurance, the underwriting surplus is technically the profit for the shareholders. So if you give, for example, $1 as premium, usually 70 cents will go into paying the compensation or indemnity. You are left with 30, and the 30, maybe 20 will go further in administrating the company, and the 10 cents that are remaining, this is a net profit. So usually it is between 65 to 70% of what you pay go in towards paying the risk indemnity. So what is left over is for the shareholders. But in the case of Takaful, that's not the case, because the underwriting surplus, the nature of it is basically your tabarru'at, the donation that you have given. This is equivalent to your premium. Now, what do we do with this? Because the shareholders, with a mindset of conventional insurance, they say, but this is supposed to be ours. So this is where at times you get a problem. So the AAOIFI set up some guidelines on that. Let's see what the AAOIFI got to do to say. First, let's look into the definition of surplus. How do we understand that? In simple terms, the Takaful fund surplus at any point in time, T, would be surplus at time T is equal to Takaful fund asset at time T minus Takaful fund liability at time T. So S bracket T is equal to A bracket T minus V bracket T. It's a very simple mathematical representation. So this is what it is. Your asset minus your liability gives you a surplus. Now, this, I won't go in detail with it. It's not that easy from an accounting and actuarial point of view. Basically, in Takaful, surplus is defined as assets minus liabilities of the Takaful risk fund. These liabilities are further defined as both accounting liabilities as well as actuarial liabilities. So the accountants, usually they will work with the historical data, whereas the actuaries, they will try to make further provisions in the future. So that is cause some imbalance in the account with the figures. So this is where in determining the surplus, usually it will take about one year or 1.5 years to finalize the account, because you got to readjust it, and then only you will determine the surplus in practice. You don't expect to get it within 1 year. It's very, very, very difficult to calculate the underwriting surplus, because there are outstanding fees, there are commission, there are Takaful commission. There's so many things involved in there. So usually after 18 months plus minus year end, that you can technically calculate your surplus. Now, the AAOIFI standard is Shariah disclosure basis of determining and allocating surplus or deficit, because Islamic insurance companies refer to the shareholders want it because in their eyes it is the excess of total contributions paid by policyholders not during a financial period over the donation, what is left out of the donation in respect of claims. How can that be profit during the period? So this is net of reinsurance. And so the first point I want to raise is entitlement to the insurance surplus belongs only to the policyholders. This is clear-cut in the AAOIFI standard. If you look at the shareholders do not share in this surplus, because the shareholders got their authorized capital account. That is what they have, and it is any investment or wakala fee, this is where they get. They don't have right technically, according to AAOIFI standard, into the whatever is surplus in the Takaful pool, because it belongs to the policyholders collectively as defined by the insurance or Takaful agreement. Several fatwas and Sharia rulings have been issued confirming that policyholders have the existing right to the insurance surplus. Okay, so it is clear cut from a Sharia point of view that given that this excess is from the donation, after you have paid the claims, you have paid the expenses, etc., that money is still what is left out of the donations. It is not technically a profit. So this is why I'm saying underwriting surplus. Yes, if it is from investment, you have invested it, then the Takaful operator can get money from the mudaraba profit. So there are two things you have to understand. One is a wakala fee they take to manage the pool. The other one is a mudaraba contract when they invest it. So there are two ways they can get money. But they cannot claim from the underwriting surplus, because this is technically the capital of the pool, and you don't take the capital of the pool technically. So there are some differences of opinion among the ulama. I don't want to go too much into those details, but generally this is an understanding in the industry. So the insurance company may invest that insurance surplus for the account of the policyholders. If there is an express provision to this effect in the insurance policy, the consideration payable to the party undertaking such investment, that is a percentage of investment profit in the case of mudaraba, or amount of commission in case of agency, should be specified in the insurance policy. There is another provision in the AAOIFI standard, which is an accounting standard, where there is a performance fee. So if you are doing very well, you are managing the pool properly, this can be another source of income for the shareholders, because if the pool is very healthy, you can get a performance fee, say about 5%, whatever, from the underwriting surplus. But this should be agreed with the policyholders or the participants right from the beginning. Okay. So in case of should be specified in the insurance policy. You got to be clear about it. The third point is the party undertaking the investment is entitled only to the consideration specified for this purpose and should not appropriate any amount from the insurance surplus, which is a residual from the premium contributions, as we have discussed. Premium here would mean your donations. Now, the AAOIFI have given various ways to distribute that. I'm dealing three here. One is the pro rata mode. That is where the surplus is underwriting surplus plus profit, or underwriting surplus only. The underwriting surplus, which is the debate here, not the profit of investment. So if you are taking the pro rata mode, it is distributed in proportion to the premium paid by the participants. So if you have contributed, say, 20% to the pool, and there is a leftover of, say, 100, because you contributed 20%, pro rata to that, you get 20 out of the 100. So this mode seems to be in line with the objective of Takaful Ta'awun, which is to provide mutual guarantee and reciprocal risk protection. The second one is the selective mode. This mode tends to indemnify non-claimable accounts only. So in other words, if you never claim, which means you never benefited, because those who claim, they already benefited. So therefore, they cannot ask further from the remaining, because you have taken the necessary precaution not to let the risk materialize. Other people might not have taken the right precaution. So it is more in line in this thought of justice who can get it. So the second one, the selective mode, in other words, if you have not lodged a claim, then you can get from the underwriting surplus. So the third one is what we call the offsetting mode. This mode tends to offset the rate of underwriting surplus from the amount claimed. This is applicable only on accounts whose underwriting surplus is less than the claims. If the underwriting surplus is equal or more than the claims, then the participant does not share in the surplus. This mode is viewed as the most equitable amongst the other modes. It is more accurate in terms of calculation and more so in terms of justice and ta'awun, that is helping. So look at this diagram, the practical aspects of surplus distribution. So you get your risk contribution, that is your tabarru or your donation. It goes in a risk pool. From the risk pool, you are paying the claims, that is the indemnification. And what is left is your surplus. So you have three ways: not to be shared, and 100% is kept in the fund. This is one way. Not to be shared with operator, but okay to share with the participants. So the first one is a case of a waqf, for example. The second one is a case of a wakala, for example. The third one is be shared with operator and the participants. So like a case of a mudaraba, or as I told you, you can have what you call a incentive fee, which is also dealt with in the AAOIFI standard and in the accounting standard. Then you got the savings fund. This is where, when you are investing, so there are two main departments in an insurance company. One is the underwriting department, where you assess the risk to calculate the tabarru to be paid. And the second one, once the cash inflow, the cash gets into the fund, you got to invest it, because if you don't invest it, it's going to depreciate. So you have to invest the money. So this is where you get the savings account, investment profit shared with participants. That is where you do a mudaraba. So you can see there are two clear-cut paths that a takaful company will take. One is the bulk of the money will remain in the risk pool, and the other one part would go into investment. So the Takaful company, there are various ways you can create hybrid. The promoters will get money from a wakala fee, sharing the profit in the mudaraba, and maybe also with a performance fee if there is underwriting surplus and they're managing it properly. If not, if it will not be valuable, why on earth should they give money if they are not getting a good return? So you got to understand this entrepreneurship element into a Takaful business. Further issues we can consider, Section 5 deals with principles and Sharia basis of Islamic insurance. You can read that. Section 6 deals with types of Islamic insurance. You've got two main types. One, the short-term risk management. The other one is long-term. In other words, the technical term is, the long-term is known as the family takaful. Short-term is known as the general takaful. And this cascades into many types. Section 9 of the standards, conditions in Islamic insurance policies. The AAOIFI has given some guidelines there. However, I want to highlight what I've said early on. The insurance contract is a sui generis contract. You cannot just draft a policy, a Takaful policy, as you wish. It is very, very, very intricate. There are specific conditions that needs to go into a contract. The AAOIFI standard hasn't gone into that length because this is Sharia standard, not a legal standard. So you got to look at the law of your land, the Insurance Act, things like umberi fidai, is the issues like insurable interest, the concept of subrogation, etc., which usually will be encapsulated in a policy. Then Section 13, very important, the expiry of the insurance policy, because usually if it is a short term, in other words, general, it will be 1 year. If it is life takaful, it can go, it's become an investment policy technically. So you got to keep that in mind, because if it is general, today you are with one company, that money goes there. If it is surplus and you're no more with that company, what do you do with this money? So that is another technical aspect in fiqh that the ulama have discussed, but this is not the right forum to discuss the changes of the participants in the pool. So this is all from me for today. I hope I've been able to highlight some salient features of the Standard 26. We cannot cover everything, but I hope it gives you a bird's eye view about this standard. Thank you very much for your patience, and inshallah, Allah wills, I'll give another session later. Jazakallah khair from Faizal Manjoo. Fi amanillah. Assalamu alaikum wa rahmatullahi wa barakatuhu.